Pre-market commentary on April 15th, behind the violent rebound in tech stocks, a return to fundamentals or a dead cat jump in liquidity. Greetings everyone, I'm James. It's 6 a.m. Eastern time on April 15th. Now reviewing last night's April 14th US stock market, major indices collectively surged. S&P 500 closed at 6967.38 points, up 1.18%. The Nasdaq closed at 23,639.08 points, up 1.96%, and the Dow Jones, it closed at 48,535.99 points, up 0.66%. Now, looking only at the indices, this rally seems calm, but the underlying asset correlation is unusually strong, especially after international oil prices broke through the $100 mark. Tech stocks surprisingly led the gains against the trend. This contradicts traditional experience, reflecting a highly complex game being played in the market regarding Federal Reserve's policy expectations. Let's break it down in depth. First, let's talk about tech stocks. Defy the trend? Did the Fed provide reassurance? The biggest surprise last night was the Nasdaq's significant lead in gains despite energy pressure. Core logic, the market is betting on the Fed maintaining a dovish bias. Core logic, the market is betting on the Fed maintaining a dovish bias. On Monday, Chicago Fed President A. Goolsbee stated that the current surge in oil prices is considered a short-term factor. As long as the shock is temporary, the Fed will not easily change its established monetary policy path. He emphasized that as long as consumer confidence and spending remain strong, economic growth is expected to continue. Some of my thoughts: the market interprets this as meaning that as long as the war-induced surge in oil prices is not seen as a lasting shock, the Fed is unlikely to tighten significantly ahead of schedule. So this provides a valuable respite for undervalued tech stocks. However, it's important to note that if oil prices remain above $100 for several weeks, this expectation will instantly collapse. Now, do you believe the tech stock rebound represents a genuine reversal or merely a dead cat bounce? Give me a 1 if you think we've hit rock bottom. Give me a 2 if you think there is more downside ahead. Now, let's talk about oil prices. Shifting from a panic spike to a stalemate phase, crude oil price action was extremely volatile on April 14th. West Texas Intermediate crude retreated sharply on Tuesday, closing at $90.94, a single-day decline of 7.87%. Previously, driven by tensions in the Strait of Hormuz, oil prices had briefly surged in the vicinity of $105. However, as expectations emerged that a window for peace talks had opened, speculative forces moved to quickly take profits. Brent crude faced similar downward pressure, though it staged a slight rebound to $95.60 during Wednesday's US trading session. Now, the prevailing market consensus is that the $100 mark serves as a critical psychological threshold for oil prices. On the downside, the $95 level acts as a short-term support. On the upside, $100 to $105 range forms a strong resistance zone. Viewed through this lens, market dynamics within the energy sector are shifting from a strategy of buying the geopolitical conflict premium to one of buying into high volatility assets. Okay, so give me your thoughts. What do you think? Do you think West Texas Intermediate will firmly establish itself above the $110 mark before the end of April? Give me a 1 for yes or a 2 for no. And now, one of the questions many of you are asking about, gold. Let's talk about gold. Gold's recovery, returning to equilibrium after a liquidity-induced sell-off. On Tuesday, gold experienced a dramatic liquidity shakeout. Prices briefly plunged from $4,739 to the vicinity of $4,644, a drop of approximately $95. However, gold prices subsequently staged a rapid recovery, climbing back to around $4,780 by last night. Some of my in-depth analysis, the price action was primarily driven by a concentrated short-term surge in market selling, triggered by extreme panic and or intense pressure to meet margin calls. Now, as market conditions stabilized, gold's status as a safe haven asset was reaffirmed. From a technical perspective, the $4,750 level has now established itself as a solid support. With market stability returning, gold has successfully resumed its traditional role as a safe haven. From a technical perspective, gold prices have currently established solid support around the $4,750 level. If the US dollar index continues to fluctuate at elevated levels in the near term, gold may face short-term consolidation pressure. However, from a long-term standpoint, the market has reaffirmed gold's status as a safe haven asset. What about you? Give me some of your thoughts. Do you think gold will reclaim the $4,800 level this week? Give me a 1 for yes, give me a 2 for no. And now, another one I get asked about a lot is Nvidia. The final stretch of a 9-day winning streak? Well, Nvidia delivered a standout performance last night, closing at $196.51. On April 14th, the stock surged 3.8%, successfully breaking through the key resistance level of $190. Let me repeat that. Nvidia delivered a standout performance last night, closing at $196.51 on April 14th. The stock surged 3.80% successfully through the key resistance level of $190. Now, talk about some fundamentals. Data from the ORN. ORN provides data infrastructure, including the ORN Compute Price Index, OCPI, which acts as a benchmark tracking for live transaction-based spot prices for GPU compute. In case you're not aware of ORN, that's what they're about. But the data from ORN indicates that cloud rental rates for the Blackwell series GPUs have risen to $4.08 per hour, a 48% increase compared to 2 months ago. Demand for computing power remains insatiable. Valuation and risks. The forward PE ratio stands at approximately 20x, which remains an attractive valuation. However, a key risk factor is that Nvidia executives have collectively cashed out over $3.3 billion in stock over the past 18 months. Now, while most of these sell-offs were executed under pre-established trading plans, they nonetheless serve as a signal that the stock price is now trading quite close to its previous all-time highs. Now, intraday focus, if the stock breaks above $195 on heavy volume at the open and holds that level, the $200 milestone could potentially be reached this week. Conversely, if investors remain on the sidelines and the stock retreats to below $190, it would suggest that short-term momentum is waning, prompting the market to shift its focus to the earnings guidance expected in next week's May financial report. So, what about you? Do you think Nvidia will break through the $200 mark this week? Give me a 1 if you think it will break through, and give me a 2 if you think it won't break through. Now, what about the bank sector earnings? Cautious outlook amidst impressive figures. Well, JP Morgan Chase delivered a stunning earnings report on Tuesday. EPS, earnings per share, came in at $5.94, an all-time high, far exceeding the analyst consensus of $5.45. Again, let me repeat that. An all-time high, far exceeding the analyst consensus of $5.45. This strong performance was driven by robust growth in both trading, revenue, and investment banking operations. Although Diamond warned that a potential war with Iran could drive up inflation, CFO Barnum stated that consumers and small businesses remain healthy. Now, this suggests that while the banking sector's first quarter earnings are already largely locked in, future loan demand and asset quality remain uncertain against the backdrop of $100 oil prices. And during today's trading session, the earnings results and forward guidance from financial stocks such as Wells Fargo and BlackRock will be crucial for the market to determine whether the financial sector can sustain its recent strength. Now, my question to you is, how long do you think the banking sector's earnings miracle can last? Give me a 1 if you think the earnings season marks the peak, or give me a 2 if you believe there's still room for upside. And now, let's talk about the general market overview, the 3 key indicators to watch at the open. All things considered, please pay attention to the following 3 indicators at today's market open. First, the VIX Volatility Index. It is currently retraded to 18.36, nearing its quarterly low. If it continues to trend downward, the tech sector's rebound is likely to gain further momentum. Conversely, an upward move would signal a resurgence of risk aversion to the market. And second, the 10-year US Treasury yield. It currently sits at 4.25%, a retreat from its recent highs, yet still well below the critical warning threshold of 4.6%. Should yields surge significantly upward once again, it would inevitably suppress growth stock valuations and thereby dampen the tech sector's rally. And third, whether Nvidia can firmly hold the $196 level is of paramount importance. This serves as one of the market's key barometers for confidence in the tech bull run. Dun, 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 dun. Come on, have some fun with me, right? A sharp pullback in Nvidia would signal growing investor anxiety regarding the momentum of tech sector leaders, potentially prompting the broader market to shift into a wait and see mode. Now, I've seen some comments with questions like, tech stocks are rebounding. Should I go all in to bottom fish, or is gold rallying? What should I take? Some profits immediately? Since these questions involve your specific positions and risk tolerance, your situation, it's better to reach out directly to my assistant. Send us details regarding your current holdings and cost basis, and we will provide you with some personalized advice based on the latest institutional positioning heat maps. In the current market environment, timing and rhythm are far more critical than simply predicting direction. Now, that wraps up the pre-market briefing for today. Here's some 3 final points. First, reach out to my assistants. The contact details are located at the bottom of the screen. Reach out and be sure to enter today's passcode APR15PRE. You will receive a copy of April 15th US stock sector capital flow chart, allowing you to clearly discern whether major players are exiting the market or simply rebalancing their portfolios. Number 2, make sure to turn on notifications. Hit that bell icon. I will be going live at 10 a.m. sharp to provide real-time intraday analysis, offering immediate insights into the genuine market signals emerging right after the opening bell. If you don't have notifications enabled, you're gonna miss out. And third, stay vigilant. Remember, in an era of volatile oil prices, every market rally requires sustained logical support to be sustainable. See you in the live stream.